We are a real estate company today, not because we think that's the fastest way to growth. So back to like how we think about growth, we do it today because it's an easy way to prove out our business model and to prove out the value that we can create in real estate. Really what we're trying to do is create a new asset class called hospitality living that is flexible real estate. And so we want that to be thought of like, oh, I can build, if you have an empty piece of land, I can build an apartment building, I can build an office tower, I can build a hotel, or I can build a hospitality living building. That's ultimately where we're trying to do is that it's just one of the major food groups of real estate that is flexible.
Welcome to the Hypergrowth Experience. This is Nima Gardide, your host. Today's guest is Bao Vuong, president and co-founder of Placemakr, formerly Y Hotel on the podcast. They've been growing 100% year over year, which is quite impressive given that their original model wasn't going to do well during COVID. And they were able to sort of pivot as part of that and in fact build a much stronger and sort of long-term version of their company. And they recently raised $120 million, and they've also raised a sort of debt facility or another sort of fund of $250 million to invest in real estate. It's quite interesting to learn about their business because they effectively use one single sort of formula to drive the growth of the company and the way they connect their internal sort of business, which manages buildings in these unique ways, to investors on real estate side, and then to potential renters and short-term stayers or hotel guests. We've had some experience on our end at Paramil with a company called Sonder, so I understood a little bit of this, and so I was able to really ask decent questions and get to know the business a little bit. And obviously they're quite thoughtful there at Placemakr, and they've done a really good job getting to this stage. And Bao talks about this new asset class they want to create for hospitality living to bring a different approach to sort of building buildings and building communities. So that was really fun to listen to and think through with him. To start, he shares how he met his co-founder and the original story of how Placemakr and rather formerly Y Hotel came to be. Let's get into it.
So my co-founder and I have known each other for, a little over a decade. We both come from the real estate industry, so institutionalized real estate. He was responsible for a couple $1 billion worth of real estate with the publicly traded REIT, and I worked for one of the largest private developers in Washington, D.C. And so we met each other through an industry association called ULI. And I was a part of a group called Young Leaders Group. I was a chair of one of their committees, and he was one of my folks on the committee. And I asked him one day, because he was always on top of it. And one day I was like, hey, do you want to come work for me? And of course, he promptly rejected me and said, no, I'm good from where I'm at. And then I think he talked to a few other of his mentors, and ultimately, where he wanted to go in his life was around entrepreneurship and working for a real estate developer. You get to see a lot of different things, and you get to act like an entrepreneur in many ways. So his mentor convinced him to come work for me. I tell him I was the best thing for him in his career, because he came to me, skipped a level, then went back and skipped like 5 levels, going back, actually working for the same company. But we kept in touch over the years. And, we ultimately, the beginning of Y Hotel was his idea. And it was started as an entrepreneurship opportunity. So he worked for, like I said, a publicly traded REIT, which is a real estate investment trust. It's a way to allow the everyday retail consumer to invest in real estate in the tax advantage ways that real estate provides the really wealthy, quite frankly. And so the company owned a few million square feet of development in an area in the DC metro called Crystal City. And so they were trying to figure out how to make that area more lively during the nights and weekends, because it's really like a suburban office park, even though it was so close to DC. And so how do you make it 24/7, 365 days a year? And so that it means there's a bunch of office there, but there wasn't retail and there wasn't residential. And so to do that, they had to bring in a bunch of residential. And so that's a lot of risk. And so they're trying to figure out how to de-risk that investment. And so that's really how Y Hotel was born, and that's the precursor to Placemaker, is that we were essentially a pop-up hotel operator, where when you build 300 or 400 brand new apartments, it takes anywhere from a year or two to fill up the building with long-term residents. And so we would come in, take 100 units out of the vacancy that would otherwise be empty, fully furnish those units and operate a hotel out of the vacancy, creating interim income for the building owner, but also providing great stays, right, for the guests that stayed with us, and also created a liveliness in the building for those residents who were some of the newest tenants in the building. So the building didn't feel so empty, like provided some liveliness, while also providing them services. So we would do free cleanings for them. We gave them discounted room nights. So it was just kind of a win-win-win situation. And so that's how the company originally started. But really, and so it was done as an internal pilot as a part of Vornado. Luckily for Jason and I, and sometimes better to be, I guess, structurally lucky than good, REITs can't operate hotels. And so for this thing to grow, it had to spin out of Vornado. And so Jason was able to spin it out of Vornado, and that's when I joined him.
Oh, interesting. So you were basically like solving a problem for these funds that were, well, they want to deploy all this capital and build all of these residential units, but they are not going to make money for a couple of years or not going to break even or whatever. So you're trying to coming in and helping them get earlier sort of cash out of the investment. And then you would just be done at some point, right? Like 2 years in, these buildings will be filled with actual long-term tenants and you'll get out.
Yeah. Really two focused on two things early on. One is risk mitigation for them, and then early cash returns, right? And so, so we would start off with 100 units, and they would, start off with 10 units full. And then as they got fuller and fuller and fuller, we would get smaller and smaller and smaller, right? But like I said, that's how the business started. That's the original concept, but we've always believed in a better way and a more resilient way to build real estate. So that's how the idea, like I said, the pop-up hotel was how it started, but that's ultimately not where my partner and I wanted to take the business. And we kind of knew that from day one. What we're really focused in on, though, was how do we sequence that in a thoughtful manner? How do we make that transition over time? Because, real estate's it's a really slow moving business. And it's hugely capital intensive. And, you think about the scale of real estate, when you hear a startup that hits $1 billion valuation, it's a unicorn, right? Real estate, that could be a half a building in New York City, right?
Oh, yeah.
And that's the scale. And a lot around real estate, it's about wealth preservation, right? And it's using it as a financial instrument, a risk-adjusted financial instrument. And so there's just not a lot of innovation in real estate. And so we're trying to turn that around a little bit and say, hey, how do we leverage the platform that exists today with real estate? How do we innovate on it to create higher returns for owners, while at the same time create value for those who use the building?
And also, so walk me through, what you mentioned there is interesting, because there's like multiple types of personas that you have to sort of like serve. What are the different ones? So like you just mentioned the owner of the building, there is the tenant. I assume there is like some fund and or investor. Are there like more people that you have to sort of serve? Like what are the different entities, and what are their different sort of needs that maybe sometimes clash or sometimes are aligned together? Yeah,
you hit the nail on the head with the three big ones, quite frankly. And it's a triangle for us that always have those competing needs. And it really is, we are a two-sided market, right? And so we have to serve the real estate owners and what they're looking for, which is basically risk-adjusted returns on their investment, right? And then we have to serve the needs of the ultimate users, right, who stay in the building, whether those be residents in the building, whether those be hotel customers, or whether those be, kind of long-term extended stay guests that stay with us. And then lastly, we have to serve ultimately the investors of our company, right, and our employees. And so those three things are in constant competition. And the balance between those three things is pretty tough, because I think they change over time, where you put the weight, depending upon what stage of the company. And so early on for us, it's all about the real estate owner, right? Because in many ways, if we can't bring on the pipeline and we can't create something that creates value for them, we don't get to create the ultimate value for the customer, right? Because they don't allow us access to their apartments. In the long run, though, as we get more and more hotel units, and we're able to evolve the business, and we can prove out the value that we create for the real estate owners, then we have more flexibility to focus on our end user, and ultimately that customer demand for whether that's hotel nights or residential nights will drive the desire for the real estate owners to actually bring us into their building, right? Because that's how you create more income for them, is through that consumer demand. And so it's a little bit of a catch-22.
People have different phrases for this. It's like a catch-22, or like a chicken and egg problem, or like an atomic network problem. And if you're reading like growth literature, like from the sound of it, it seems like the supply part was extremely important. First, you need to like really solve the problem for the owners of these buildings. And then as you have more supply, having more demand also is, kind of helps the supply. So you can kind of do both of these over time. Are you still doing that version? Okay, before actually I go to that, what about your investors? Like why would they want or need a different outcome other than like these two other parties, the supply, which is sort of the real estate owners, and the demand, which is like the people who are staying there? Why would they want something different than what both of these parties ultimately want, which is a good experience and returns?
Yeah, I mean, ultimately, our investors want financial returns, and in today's environment, for startups, really a drive towards profitability, right? And so every dollar that we make, right, as Placemakr, it's a dollar less that the real estate owner gets. And it's potentially a dollar more that we have to charge the consumer, right? And so that's really the push and pull, is like, hey, we could charge the building owners $0 and provide our product for free. They would make more money, which is more likely they would bring us onto their next building, but we would go bankrupt, right? And so that's really the concept, is like the more money that we make as a company, the less money they make as a real estate owner, the less value we can provide to the consumer. So there is a little bit of a push and pull on that.
And how much of that is like market forces that are not in your control? Like there's like, because of the competition in the space for the net renting market in DC, let's say, you just cannot push the customer more or push the owners more. Like, is that a lot in your control as a company, or you're kind of like beholden to the market and you're just kind of letting the market help you find the equilibrium in where you kind of make your money on the landlord side versus the renter side?
So two different equations. And I don't use the landlord side because, unlike some of our competitors, we don't actually lease the units. So we manage the units on behalf of the owner. And so we don't sign leases. So it's not the WeWork model effectively, right? Or Sonder. And so we manage on behalf. And so in many ways, we get to create a little bit of our own rules because nobody manages buildings the way we manage buildings today. But there are models that do similar things that we have to constantly compare ourselves against because we have to convince them to bring into our building, convince them to bring us into their building and to make it worthwhile, right? That we're somewhat comparable with what the market's out there. And so the two big groups that we are constantly monitoring and the market forces, as you would say, that we're competing against, one are traditional multifamily operators. So think of the Greystars of the world, think of Bozzuto Management. There are a few other large ones, right? And your mom and pop management companies, right? There's a lot of those small ones that are local to certain markets all over the country. And then on the other side, on the hotel side, is that the management fees that we charge are comped up against hotel management companies, right? So that may be the Marriotts, the Hiltons, the IHGs of the world, but in many cases, it's not. Those are just the brand, the flags, and the bodies on the ground actually running those hotels are with other. They're actually with management companies that all they do is just run hotels on a day-to-day basis. And so we compete against them. And so therefore our rates that we can charge have to be comparable. But like I said, nobody runs flexible real estate, which is probably 80% of our business today. And so we do get a little bit of leeway in trying to drive rates there because we have a differentiated product. On the consumer side, the rates that we charge, it's basically driven by the market in most ways, right? And I think this is actually one of the challenges with real estate in general. We can talk about that when we get into like how we pivot our business and why we pivoted our business and that business model. But it's, there's a plethora of information for both residents and hotel stayers, right, alike, to comp against other type products, right? Whether that's through apartments.com or whether that's through booking.com or whatever, right? Is like they know what hotel rooms are selling for. They know what residential apartment units are selling for. It's really, at the end of the day, it's somewhat commodity product. And so we can't charge more than them to the extent that our product isn't differentiated. Now, it is a little bit, but when I talk about the competition with our company, it's really about how much do we put into R&D to make the experience that much better, that much simpler, that much cleaner, right? For the end user, for the consumer, that then balances against like, hey, the needs of the company. Because obviously the more in R&D, the longer it takes to get to profitability, right? And to balance that piece out. And so that's what we're constantly thinking about.
And this R&D part is like software, consumer-facing software that helps me book and then manage my stay while I'm there. Plus, I assume there is like a highly operational aspect of like there are cleaners coming in, maintaining like the quality of the spaces and all this sort of stuff, right? So like it's not like a pure tech company. It's like tech plus people, which is really tech plus processes run extremely well, right?
Yeah, it's kind of a complex problem because also when you think about the tech side, I mean, we call ourselves a tech-enabled operating platform, right? And so that's tech-enabled both from the consumer side. So we think about, to your point, ease of booking, ease of reservation, ease of signing a lease, right? To ease of getting into the building, contactless check-ins, right? And so that there's a tech component on that side, but then to your point, there's also a heavy tech component on the building management side. And I'd say so that's one of it, is that there's ultimately where we're trying to go is flexing real estate constantly, right? To maximize value for those involved in it. And when you think about constantly flexing the real estate and switching uses, is that there isn't a management platform today that allows you to do that. Right. They're very focused and specific. There are hotel property management systems. There are residential property management systems. There's not a way to manage that inventory in a single system today. And so we are building that. We have done that successfully to date. The other piece of that is thinking about the pricing algorithm, right? Is that largely hotels are priced really trying to figure out how to price a one night stay. And that's really what they're focused in on. And they're really focused in on top line. For a hotel, they're really just focused on maximizing 1-year leases. And given our flex model,
residentials are focused on
the residential side,
yeah.
Right? And then, but given our flex model where you can take a single unit and it can be a 1-night hotel stay, it could be a 2-week extended stay, it could be a 3-month relocation stay, it could be a 6-month temporary home, it could be a 1-year unfurnished stay. And so as we think about that, it's like, how do we price across that, right? And not only is it focused on top line, but there's different expense models associated with each one of those different stays. So really what we're trying to do is price bottom line profit, right? Is how do we maximize
what is like the
NOI?
right mix of these things to make the most money out, basically, right?
Exactly.
So do you have are you like basically every unit you have, because of that model, is listed both on booking.com and on apartments.com and on Airbnb and all these different sort of like online travel agency companies, all the way to like real estate property listings companies? Like you're trying to be everywhere at the right price point for the right sort of like mix that you're looking for. Is that what's happening?
That is what's happening. And so we may not have every single unit, but what we have is a percentage units or unit types that we list, right? So we will always have 1 bedrooms and 2 bedrooms and studios listed on the hotel side. And we may or may not always have it on the residential side, depending upon demand. So what we're doing is we're saying, hey, let's take a look at the world of demand out there, right? Who's coming in? Why are they coming in? Let's look at what's the demand for an apartment? What's the demand for relocation? What's the demand for a hotel stay? And then how should we think about the percentage of our buildings that we allocate to each one of those uses at any given point in time? And whether that's both from macro demands, right? Where COVID hits and and there's no longer hotel demand, right? And so that may force you to change to 100% unfurnished to apartment-like stays, right? Or whether that's micro demand changes where you've got a 500 unit apartment building and somebody built a brand new 500 unit apartment building next to you. And they're trying to fill the building up. And so when you do that, you generally drop rates, right? And so now you, as the building owner next door, has to decide, do I drop rates with them? Because that's what you're going to have to do. Or do I start flexing more into, right, hotel-like stays, right? Or other different types of stays to help try to keep the net operating income, right? The income of the building high, right? And so that's the beauty of our model, is it allows you to think about customers differently and pivot the business. And if one of the examples I can give is if you think about COVID, and I mentioned earlier, hey, you would go 100% apartment. Well, actually for the 2 hotels that we had already stabilized pre-COVID, right? Instead of going back to multifamily, what we did was we pivoted the business. Instead of going for 1 and 2 night stays, like hotel-like stays, we switched to long-term stays because we have apartment-like product, right? Where somebody can truly live there for weeks and months and a year at a time. And so in DC, the hotels around us were earning about $20. They call it RevPAR. So it's like, how much do you make? How much revenue do you make per available room night, right? So on average, how much money do you make per room, right, that you have in your hotel? DC on average at that time during COVID, I think was like $20 a night. And in our hotel, we were averaging over $150 a night, because what we did was we pivoted from the 1 and 2 night stays to longer term stays. And, we had a number of groups that for a number of reasons who had to stay in DC for extended amounts of time. Same thing with our hotel in Seattle, where they were also, low double digits for RevPAR, and we were over 200. And that's just the ability to go after different types of customers.
And so when you say like we pivoted, what you've actually done there is change the pricing slightly and then go on different channels to advertise the inventory or like put the inventory out there, right? So you go to real estate channels instead. You're like, hey, I'm looking for longer term stays and so on and so forth. So that's really like what you're playing with there. I really like this type of business because it's really just mostly math. So you're spending a lot of time on this math part. So is a lot of walk me through your like just in terms of investment that you're making as a founder into teams, right? So like how big is this like team that cares about this modeling versus a team that is doing the ops portion versus the team that's maybe doing software building for building software for the users on both sides of this ecosystem. So like, where is your money going?
I think you hit the nail on the head where you talk about teams and where our money is going is that like we are very, even despite the fact that we do own real estate, I can tell you how that works separately, but we're really, our operating business is really an asset light model. And so I'd say 80% of our expenses is all on people, right? And the type of people that who do we want to bring in, right? To execute on this model. Today we have a little over 2,000 units under management across 12 properties. And so that right now we have a staff running that of a little under 300 people. I'd say 200 of those people are operating, our property operating staff, right? They're boots on the ground. They are our GMs, our AGMs, our maintenance techs, our we call them guest experience associates or front desk managers, and heart of house, our housekeeping staff, right? And so they're on property, their execution. The other 100 is our corporate staff, right? And I'd say about, we probably have 20 or 30 people, probably 20 or 30 people focused in on bringing pipeline into the door, right? So more units, whether that's
on the inventory side.
On the inventory side, whether that's just managing real estate on behalf of others, or actually us going out to buy the buildings. And then we have I think probably about 20 people on our, I'd say, tech and product team. And then we have some overhead, and then almost everybody else in the corporate team supports the properties in some form or fashion, whether that's through revenue management, whether that's accounting, whether that's financial analysis.
And this formula that you talked about the mix, is that would you call that revenue management? Is that what you just mentioned, or is that something? Okay, gotcha. So it's just, is it done manually? Is there like ML machine learning built into that? Like what's going on there?
We do both today. So we run a heavy Excel model that needs people intervention, right? But then we also have a data scientist and some team members working on building a pricing algorithm, right? That can quickly work through how we think about pricing stays and how we think about demands. And today, first step is to think about, it's really a displacement model, right? Because as soon as we put a one night stay in, we can't put in a 1-year lease, right? And so what we're thinking about is how do we think about displacing different types of potential guests that stay with us? And then what's the best way to think about percentages of the building of what types of customers, once again, to maximize income for the real estate owners.
How often are you changing this type of mix right now? There is a model there. I assume there is like all these macro things that happen that shift maybe like the minuteness of the pricing. Like you might go up and down by X percentage every so often. How often is that happening, first of all? And then how often are you like rethinking the rev model completely on a building or like on a set of inventory?
On the pricing side and what the consumer sees, we price every single day, right? We're daily changing prices, and we're not only changing prices for today, but we're changing prices for the next 365 days. right? It's a pretty complicated model, which is why we are building the algorithm and why we're testing it out and why we believe that there's a lot of inherent value in that. It's because it's a complex problem and you're constantly changing prices, right? And so you need to take into account demand for any given day, right? So, if we're talking about, March, let's talk about in April for DC, cherry blossoms is huge, right? And so even though even though people may not be booking quite yet, we know that that particular month is going to be super strong. And so we may hold out inventory or hold out pricing until the very last second because we know we can fill it with demand. And so we're thinking about how to do that and what kind of pricing do we think we need for that to get what we want out of it. On the longer term side of or the larger picture of the building, how often do we change the percentage of the building from one use to the other? I think it's really driven by, it could be two different things. One is, on a quarterly basis today, we're thinking ahead, right? 6 to 9 months. Hey, what does the demand look like? Is there anything that's changing? Should we really be thinking uses? It's not to say that we're actually changing the percentage, but we're at least quarterly on a basis and some of those monthly thinking about, hey, what's coming up? Should we be changing? And then I think the other thing is when major events happen, something pushes us to change, like a COVID, like something else, where we have to react, and so we may change the use of the building. I'd say that there's also a third reason, which is thinking about the rhythm of the building and the rhythm of demand in a particular area, right? Where we may naturally every springtime think about, hey, we're going to push more towards hotel, right? And maybe we sign different types of leases, right? Or if you think about student housing, right? Where a lot of student housing today, they may make students sign for a full year, right? They may make you sign from an August to August lease, but maybe your internship isn't in that city. You're still forced to pay the rent for, May, June, July. Yeah. And so what you can do is then, instead of making it a 12-month lease, right, which really benefits the real estate owner, what we could do is make it a 9-month lease. And especially in a market like DC where tourism is great in the summer, right? A lot of families come. I could turn that student housing, right, into a hotel, right, for families. And so therefore, it drives higher income ultimately for the real estate owner. The students get a discount and the travelers get a great place to stay, right? Yeah. For the summer. And so that's really how I think about
the actual problems people have there as opposed to some archaic notion of a lease that's 12 months, right? That makes so much sense to me. If I'm remembering correctly, Sonder, which used to be called Flatbook, started with just that specific part of this business, which was there's all these students that needed to go away for those months, and then they filled up the inventory with Airbnb.
Yeah, I basically, I think it started off as an Airbnb, but yes, I think he was a student at the time when he started it. And a
lot of the leases he had
exactly
were just student leases. Yep. That makes sense. So how are you So what's very curious about this for me now is that you have all these different approaches to pricing. So now you have this Excel model, maybe there's an algorithm, and it seems very localized. So DC is going to be different than Seattle versus New York and so on and so forth. So that makes a lot of sense. How are you introducing this new tech-enabled algorithm versus the Excel model? How are you going to test this? Do you divide up your inventory and say half of them are going to be priced with this Excel model, half of them are going to be priced with this algorithm? That's my only assumption, but is that how you're going to test? How are you going to test? Super curious about this.
One of the things that we focus on as a team always is in one of what we call our cultural norms, or others may call their core values, is kind of make it better, right? How do we get better? And one of those things, it's both better, big and small. And so the way that we approach this one is hey, let's focus on making it better, small, right? So let's focus on a particular problem. And we know that our Excel with people involved, we know that that's the answer we've been using to get to where we are today. And so what we'll do is we'll run that model, right? And then we'll also see what our algorithm spits out. Hey, does it seem right? Does it seem accurate? Does it seem like, how is it different? And understand, hey, what did the algorithm do versus how would that have happened with, our more, I'd say, traditional model of pricing, and kind of understand what the differences are, and then tweak the model, and then tweak the model, and then tweak the model. So the whole idea is try to make it 1% better. Cause I don't think it's one of those things where, especially with a high risk environment that we are, where we would say, hey, we're going to split the inventory and hopefully this algorithm works. And if it doesn't, those units, think about it much like, we sell rooms like, airlines sell seats. Is like, once that airplane takes off, an empty seat is an empty seat. You never get that revenue back, right? That seat is gone. Hotels are very much the same way, right? Where if there's not a head in that bed that night, there's no way to make up that revenue, right? And you only have 365 nights to sell for each and every single hotel room, right? And so that's a high risk game if you're going to say, hey, we're just going to let this algorithm price it and we'll see if it works out. And so what we're trying to do is mitigate that risk, right? And saying, how does our current model do it? How does this algorithm would do it? Where do we think, what do we think's right? What do we think's better? And constantly improve upon it to a point where we feel comfortable with what ultimately that does. And then we'll probably do some sort of split model and see what performs better over time.
So there is like a human intervention at the tail end of both of these. Like they'll spit out models or numbers, and then someone is looking at it and sort of like using their current intuition of what's worked in the past and understanding of these markets and saying, okay, well, I'm going to adjust it by X% based on what I know about this specific property or this model in the city. Gotcha. That makes sense. So you're sort of like mitigating risk by a human sitting there. But like, how do they do that? That's so interesting. So there is a person looking at these numbers, but I assume the algorithmic version of it is quite explanatory. It's not just giving you a price. It's giving you a price and explaining why it's giving you a price, so then you can like check its assumptions. Is that what's happening? Like how do I like adjust risk against these two things as someone who's looking at the output of the models?
With the algorithm side is that what we don't have is years and years worth of data, right? To just run regression models and more complicated models to say, hey, we've got a ton of history. Let's see what's driving all of the assumptions. We're still making those assumptions today because we're building that history, because there isn't a group today there isn't data that we could pull today that says, hey, like we ran this building this way, and so therefore we got this amount of income running it this way, this amount of income running it this amount, right? And so then we can figure that out. So we're still building that data today. And so that's the challenge that we face. And so we're constantly tweaking based upon what we learn. So every day we learn something new, right? Every month we're learning something new, and we're building that back into the algorithm.
I assume this data in itself is going to be extremely valuable, give it 5 to 10 more years, or you have one of the only historical data points on this, so you can compete very well on this type of sort of fulfilling of inventory. Let's step back a couple steps. So you mentioned, so like 80% of your business is this, where you're managing properties and then sort of like filling demand for the supply of owners. But you also mentioned that you sign leases. Is that the 20%? Like, what is the other part of your business, and how did you get here? So like you said, you went through like a very major pivot to get here. So you went from these like helping REITs basically make more money on their inventory before it was fulfilled properly with long-term tenants. How have you ended up here, and what were the big steps you had to take to get here?
The pivot was really around going from primarily focused on the pop-up model to really building a flexible real estate platform, right? And that's ultimately where we're trying to go, is to build a platform that enables real estate to be more resilient and to create a better financial engineered product for real estate owners, and to create value for those who stay in it. So the 20% of our business today is the pop-up model, and 80% of our business is where we fully manage the entire building and kind of forever flexing the units between home and hospitality. And so that was a pretty big pivot. And really, it was because of COVID. In March of 2020, we were set to open a pop-up hotel a month, right? Because who wouldn't want that in their building? Because it's just free money, effectively, right? And so we were focused on that, but we knew ultimately we wanted to get to this flexible real estate. When COVID hit, and we basically said any hotel that wasn't stabilized, it doesn't make sense to open. Right? It's like, let's shut down all the half-open hotels. Let's not open any new in 2020. It gave us the space, both internally and with our investors, to say, hey, because we're not trying to grow, because it doesn't make sense to open these hotels, it allowed us to rethink the business model and let's pivot to where we want to go long term. And so as bad as COVID was for the hospitality sector, and as bad as it was for us as a company, one of the toughest professional days I've ever had, when we went from 106 employees down to 28, is that it gave us, like I said, the space and the flexibility to really get to ultimately where we wanted to go in the long term with the business.
Well, that's a big change that you went through to get there. Yeah.
And it's really, and it's a lot around releasing that pressure of growth, right? Because the pop-up side of the business, it was a little bit like a drug, right? It's like, once you start it and you have to keep growing it, you have to keep feeding the machine. What's great about that business model is that it's basically free money. Like you're making money off of what otherwise would be empty product. But the challenge with that on our side is that it's a consumed product, right? It's not ARR. There wasn't any annual recurring revenue. And so as big as we got, we'd have to continue to open more and more hotels, close down more and more, open more and more, close down more and more. So it's a challenging, I'd say, business model from that perspective. Not that we couldn't have done it, not that we weren't set to do it, but it's just challenging. And so allowing us to, I guess, put the brakes on the growth for a half a second when COVID hit, really allowed us to switch to our current business model, which is more annual recurring revenue, because we're signing 5 and 10-year contracts to manage these buildings.
Yeah. And what I don't like about that pop-up model is that if you did extremely well, at best, you would basically be at the deployment of the capital on the new real estate. Because that is your limit, basically, which is a lot of money, I assume, as many hundreds of millions of dollars, billions of dollars that are probably being spent on new buildings being built, and you sort of helping recoup some of that capital, but you're still limited by how much of that is available, which I assume is still a very big business, but very hard to do.
I think they're on average, the U.S. has built around 400,000 new apartments every year. So that's really the kind of TAM that we could go after in the pop-up model. But what was nice about it is that it was a little bit, it is counter-cyclical, meaning when apartments are hot, they're leasing up fast, and we're more likely to be 12 months in the building versus 2 years because they're leasing up quickly. That means that generally that drives more entrants into the market. And so we can open up, there's a lot more product to open up our hotels in. In the same sense, though, if the economy's not doing great, right, and which means people are less likely to build new apartments, that also means that they're probably having a harder time filling the building. And so we got to stay in buildings for longer, right? So it was kind of nice that it was counter-cyclical, but to your point, it is a capped market, and it's like I said, it's a little bit like a drug. You got to keep consuming it. You got to keep getting more and more and more versus our current model where we're managing buildings for 5 and 10 years, and we can just build on top of that. Different kind of growth.
Yeah, I definitely want to address, because we're about to, I assume we would agree with this, to enter a second recession, because there was one already this past year, and we're probably going to see another one. And so you think that part of your business is going to actually become bigger because of it? There will be more demand for the pop-up part of your business in this end of this year or probably next year. And that's kind of awesome, because you have this other part of business that probably thrives in high demand environments. And then there's this other part of your business that thrives in low demand environments. So you're quite de-risked in that way.
It's actually, we have gotten a bunch of demand from both sides, quite frankly. And the pop-up was a little bit unexpected, because it kind of fell out of favor because people were leasing up their buildings so fast, right? In 2021 and into 2022. But that leasing has slowed a bunch. So that is the riskiest part of a development. One of the riskiest part of the developments is the lease up period. And so we help mitigate that. We help generate that interim income, right? Where the building is actually losing money. And so we're one of the few things that actually helps create money from that side. So we got a bunch of demand on the pop-up side. But just like the pop-up side of the business, our permanent side is that, real estate owners who were making a certain amount of income with a certain amount of debt on their building, so the mortgage on the building, all of a sudden with interest rates rising, right? Even if they thought they were hitting their top line number, their bottom line number on free cash flow has shrunk a ton because it's being consumed by increased interest rates, right? And some of these interest rates where they started, especially if they have floating rate debt, may have started around 2.5%, 3%, are probably closer to 6% and 7% today, right? And so they may be underwater. They may not make enough money as a multifamily building to cover their interest payments, right? Their mortgage payments. And so our financially engineered solution allows them, without structurally changing the building, without changing the infrastructure, with minimal investment, is to all of a sudden have opportunities to drive higher income business from the hospitality side, right? And that's one of the things that has been resilient, despite the recession that you mentioned, is that travel has been booming, and it's come back really strong. And the expectation is that it will continue to do so, both on the leisure side and really where the world's looking towards is the business travel side. But that's starting to come back, and so it just gives more diversity of income streams for a property owner to go after.
Yeah, and because most of these owners they're on variable rates on most of their loans and things like that. So when the Fed changes these rules, they are affected directly, almost immediately.
They are absolutely immediately affected by that.
Yeah, that makes a lot of sense. And you're sort of like the vitamin, or like the sort of painkiller here. You're solving that and coming in here and saying, okay, well, that margin that you used to have that just went away because the macro environment, we're going to bring that back for you by filling inventory that would have otherwise been just floating around. So yeah, that just makes a lot of sense in this market. So I'm super curious about what is your sort of like funding instrument asset class? Like, are you a venture-backed company, or are like real estate investors coming in and giving you cash? Like, because just going back to 2020, where you mentioned that there was like expectation of growth that sort of maybe went away to some extent because the market changed. So much of that expectation, and correct me if I'm wrong, comes from the asset class that you're like opting to use as a founder to fund your company and your efforts, right? Because they need some level of returns, and then so you have to run at the pace in which they want you and need you really to run to return their funds. So like, how have you been thinking about financing the company, and has it changed since the beginning? Are there multiple types of asset classes? I'm super curious about that.
We are a venture-backed company, but we've tried to be thoughtful about the money that we've gone after and like why we've gone after them, and how best can they not just be what I would call, I I don't want to like dumb money, but are just providing cash to actually, how can they be accretive to the business, right? And how could they really help us? So our seed round we raised with Camber Creek, which is a prop tech fund, right? And so they understand real estate in a very, very deep way. And they also have deep ties into the real estate communities, right? So not only are they aligned with us from our vision perspective of where we wanted to take the company, but they can also help the business grow through their connections, right? And they've been absolutely fantastic partners. But also as a part of raising that round, we tried to raise from as many high net worth real estate investors as we could, right? Because we wanted them to be part of our advocacy pool when we reached out to real estate folks to sell the business. And so that's what we did our original raise on. Our Series A is as we started to switch from kind of real estate, we knew we had to have a strong consumer presence, right? And so I talked thinking about the triangle, right? And so our Series A was led by Highland Capital Partners, and they are big focus. They have their portfolio is huge on kind of consumer-based business and consumer growth business. And so they were a strategic partner for us there. And then our Series B we raised with Harbor Capital. And they are also, although they're a venture capital fund, their money backing it is deep in real estate. And so another kind of trying to be thoughtful about a strategic partner there that's helpful. That's on the operating side of the business, or what we call, I guess, OpCo. We have an OpCo-PropCo model. And so as I mentioned earlier, we also are buying real estate. And so we create SPVs or SPEs, special purpose entities, a new LLC to buy each individual piece of real estate that we're buying. So we've bought over $300 million worth of real estate. And so that's the funding for those individual property buys are funded through separate vehicles with real estate focused money and returns. And
like a REIT would come in and help buy something like that? Or is that too many miles apart from what you're doing?
Technically, most REITs can't, yes, but not just REITs. It'd be, most of it's through private, it's mostly PE, vehicles or hedge fund vehicles, right? So funds that they have an allocation with the real estate focus or high net worth individuals.
Gotcha. So you're putting out some and that's like a sales problem, I assume. You go out there and just like constantly raise for these things, and your models will tell you, hey, like this building, we can definitely support it from the PropCo side, and there is like a very clear return on capital over X number of years. So you're sort of like separating that out of this business. VCs are invested in this PropCo, what did you call them? PropCo versus
PropCo versus OpCo.
OpCo. So VCs are invested in
the operating company and the property company.
And the VCs are in the operating company or both?
The VCs are primarily in the operating company, but we've had investments that have crossed over both, right? That said, hey, I'm buying $150 million asset with you, which I'm going to have to put 50 million of my own money into. I'm creating value in the operating side of the business. So like I want a piece of that also. And so they invest in that. And so we love that model because that really aligns our interests, right? Because it goes back to there's decisions that we may make that may hurt the real estate a little bit, meaning we charge higher fees, but benefit the operating company. Well, as long as they're on both sides of that transaction, or we may help the real estate and hurt the operating side, right? And so if they're on both sides of that transaction, we can do what's best all around for the venture, for everybody involved, right? And so like we're all aligned on growth and like how we want to extend that.
And the SPEs is what you call them. Are they equity investments into some like LLC that owns it? Are they structured as debt? Like how, I assume they're much lower risk than like a venture capitalist coming in and investing. So how are these things structured?
Yeah. So think of it's like a traditional real estate acquisition model where, I compare it a little bit like somebody buying a home, right? Where if you're going to buy $100,000 home, right, you can get $80,000 of mortgage, right? So 80%, and then you have to put 20% down or $20,000 down, right? Similar in our world, just take that instead of it being $100,000, take it to $100 million, right? And then instead of getting an 80% loan, we get more like a 60% loan, right? So we get a $60 million loan, then we need to come up with effectively a $40 million down payment. That doesn't all come from us. We raise money through what we call a GP-LP structure, so general partner, limited partner structure, where the limited partner, who are what we like to call the deep-pocketed person, right? They may foot 90% or 95% of the down payment or equity, and then we come up with the rest. And so that's how we're able to buy the real estate. But that particular capital stack, they live and die by property performance, right? And what the property can generate in terms of cash flow. So it's much like a rental property at that point, right? Do I generate enough income to cover my mortgage payment to then allow us to distribute income? And then how much do I make money? How much do I make on the ultimate appreciation of the property when I sell it? But that's all on the appreciation. It's a little bit different than the residential side, although some of the fundamentals are similar. A lot of it is driven by operating, what they call NOI, net operating income. So how much income do you generate from the operations of the property without respect to your financing costs?
Without respect to
financing costs.
Because you're looking at it as just the performance of the thing itself, forgetting what the instruments were to like fund the thing. And then, okay. So they're judging the performance of basically like how good are you at making money out of the property, and then think about how to price it. And so there are like banks involved that give you the mortgage as well, or like some funds involved on that 60% or whatever as well. So like gotcha. And then when you said 10% comes from you, is that like coming from the operating cash of the prop company, the op company? Like, where is that 10% coming from?
We then take that 10% or 5% and we then we split that up. We also chop that up into investments. Yeah. And so we bring smaller investors to fill in the GP piece. And then eventually the operating company with our either profits from deals or our venture capital funds, right, invest into that real estate. But generally, it's a pretty, given the size and scale of the building, it's a pretty minimal investment to it, and similar to not that far off of what we would have to invest into opening a pop-up hotel, right? To get that business going. So it's somewhat akin to that.
It's similar. But you're not in the business of building these buildings. So you're going there and sort of like providing liquidity to existing owners of buildings by buying them out, and then you're managing it and now are the owners of it, but in these two separate entities. If you were to like fast forward your business 5 years into the future, would you own 100% of the properties that you're sort of operating? Like, would that be the ideal scenario? Because I assume you basically make more money that way, right? That you're kind of cutting out a whole part of this triangle. Like you become one of the points of another point in the triangle in that sense, right?
We are a real estate company today, not because we think that's the fastest way to growth. So back to like how we think about growth. We do it today because it's an easy way to prove out our business model and to prove out the value that we can create in real estate. Really, what we're trying to do is create a new asset class called hospitality living that is flexible real estate. And so we want that to be thought of like oh, I can build, if you have an empty piece of land, I can build an apartment building, I can build an office tower, I can build a hotel, or I can build a hospitality living building. That's ultimately where we're trying to do, is that it's just one of the major food groups of real estate that is flexible, right? And in that scenario, we want to be the premier platform for that building, right? And today it's mixing home and hospitality, home and a hotel, but eventually, and that's because it's easy, right? And that there's not a lot of structural changes you have to do other than adding furniture and a few other things, right? But eventually, we also think that we can flex working space, co-working space, retail space, right? We think about how to better utilize and take advantage of buildings. So, and one of the things I think about is, we work out of a WeWork now, right? There's beautiful common area spaces, right, that are empty once it hits 5:00, right? And if those common area spaces could double as amenity spaces for residents or hotel guests, all of a sudden, building looks exactly the same, but all of a sudden you get a higher utilization of the spaces, right? And that once again creates value for everybody. And so, as a part of creating that asset class, what we want to be is the platform for that flexible real estate. And so that could, right today, we're everything to everybody. But eventually, what we think that means is, hey, we're the management company, the bodies on the ground that actually run the buildings, right? We're also the brand and the flag, the customer acquisition model, right? And then we're also the technology, right? The property management system and the pricing algorithm. But if this becomes an asset class like we think it will be, and we think it's a little bit of a self-fulfilling prophecy of why it'll become an asset class, but we don't have to be everything to everybody. Hey, you know what? If you want your own bodies, like most Hiltons that you walk into, it's not actually run by Hilton. It's run by a management company, right? And so if you want to run your own body, you want to have your own bodies in the building and run it yourself, great. We'll be the customer acquisition and the SaaS platform. Hey, you want to create your own Placemakr brand? Great. With your own bodies? Great. We'll be the technology that powers it. And to your point earlier around the pricing algorithm, we think that that's going to be a huge differentiator for us because, as I mentioned earlier, you can't do it without data, right? And we're one of the few people that are building that data and all that historical data that allows us to then be able to create a much more a thoughtful algorithm that then allows you to price more thoughtfully, right? And so it'll take years for anybody else to catch up to us on that perspective, even when competitors come along. And our perspective is our growth is a little bit different than, I think, a typical startup where it's like a first mover win and grow at all cost mentality. It's in our world, there's not going to be a single winner take all. There's not going to be a Google that everybody goes to. There's not going to be a Facebook, right, that everybody's going to use because at the end of the day, you have to control the physical product. And there's only but so much physical product, right? And so it's discrete and it's hard to control. And so that's why there are a bunch of successful hotel brands. There's a bunch of successful residential companies, right? And so like we're like the more people that come into the space, the better off because we want to be that myriad of menu items that people can select from as a company.
Yeah. And have you, because you have this like long-term view of this market, have you already structured everything you're building in that way that someone can come in and just buy the software piece versus just the operating piece? Or is that something like you will figure out how to decouple the org in a way where they can like sort of have their own customers for every part of this thing?
Yeah, and I think the way we think about it is we try to keep our eye on the future, understand where we're trying to go in the future, make decisions that benefit us in the next 6 to 9 months, but that don't limit us from getting to where we're ultimately trying to go, right? And so we don't want to screw ourselves for the future, but like decisions around our property management system, the enhancements that we're doing And the system that we're building is really to improve our own operations, right? And our own ability to manage the building. We're not building screens that are super pretty that we could sell to others. We think we can get to that down the road if we need to, but like really we're focused on operational efficiency, how to do things in a better way, in a smarter way for our team first. And as long as it doesn't hurt us in the future. And that's how we think about the growth is like, it's all about prioritization and sequencing of what we do. And so we don't want to spend the money too early building this beautiful and spend tens of millions of dollars spending this beautiful PMS when the demand is not for 5 years down the road.
Yeah, that makes a lot of sense. And it's like, I think a struggle for every of these like tech-enabled services businesses or tech-enabled businesses in general. I think we've gone through variations of that struggle over the past couple of years because we're also a tech-enabled business. So we could totally spend more time making the interfaces pretty enough for us to sell this thing externally. But much more importantly, we want to make sure we operate our business very well using it. So that's kind of where the effort should go. If you were to sort of like, you're raising venture capital, so that means they have to comp you against something. And you're in like, it sounds like a fully new business model that doesn't exist. How do you have these conversations with capital allocators that are hoping that they'll get returns when you IPO? And then so like, oh, how are people going to like price you when you IPO? And then how am I going to walk back towards like what valuation I should give you? Obviously, there are some like very bad examples in like the adjacent market you're in, right? WeWork completely screwed that up and went and like overvalued themselves by like, seems like a factor of 10. But there are also better examples. I think we've already talked about Sonder things. I feel like they're decently well, they were decently well comped, and the public markets actually like even brought them lower. So there is like an interesting thing going on there. So how are you thinking about your business and then going? So because this asset class wants like 100x on the original investment, right? I mean, not now. I think now you're in the B and C and D stage. You're not trying to 100x the capital, which is great. But how are you thinking about that? What am I like completely off? You're not even having those types of conversations because it's so obvious to comp your company, or are you having like, hey, let's talk about like these 3 different types of companies and how we would fit?
Yeah, it's challenging because our business is complicated, right? And it's not a typical VC investment model, right? We're not just a SaaS business, right? And so it is super complicated. I would say that we aren't a comp. I don't think we are a good comp to like a WeWork or even a Sonder because the way we make money is very different, right, than how they make money. And our fundamental beliefs are very different. So I'd say that that's actually not a good comp for us because we do not sign leases. We're not the arbitrage model, which is effectively WeWork and Sonder. What we have done to try to level set is, and like most others do in the innovation spaces, right, is to find comparable industries, right, that you can then tweak the valuations they're getting for what we do. And so like the best way we've thought to do that is to take a look at the publicly traded hotel companies, right, is to look at a Marriott, a Hilton, a Hyatt, and take a look at how they trade, apply that to us, but then adjust the factors up and down, right? So obviously we've had on average 100% growth every year since we started, right? On average, even if you include COVID, right? And so like, that's not the pace that they're growing, right? So we would expect a higher multiple than what they're getting, right? And so like, that's kind of how we're structuring the comp process. But as our space matures and as the business changes and continues to grow, I think that it will become more complicated because I think we'll have a SaaS business, we'll have a what is a flag or a franchise business, and we'll have a management company, right? And each one of those has different margins and different multiples depending upon, kind of what the investor wants. And so I would say that is one of the challenges. And is why we, as we talked a little bit earlier, is about kind of aligning interest and making sure that, the investors that you have, you're aligned at the, I think about it from, I try to apply this to everything we do, is like kind of a little Maslow hierarchy of needs, right? It's like, hey, what's their base needs? What's their middle need? And then like, what makes the wow? And so we always try to get up to the wow, which is like, hey, they believe in the same thing that we're ultimately trying to get to, which is like, we're going to fundamentally change how real estate is built. And if they buy into that, along with the kind of transactional alignment and like the relationship alignment, but they ultimately believe in where we're trying to go there, then, we try to stay aligned from that perspective.
Yeah, and that makes a lot of sense. You can be thoughtful about not only your business, but also what they care about as capital providers, right? Wow, this was super useful and fun for me. I appreciate you spending this time with me and going through your business. We've been in this sort of like general space of on the demand side in the past, and when I learned about all this pricing thing you talked about, I've heard about it a bunch, and like lots of companies have to care about this mix, and it just is an intellectually interesting problem space to be in. And I think I the first time I spoke to some of these pricing managers at like similar companies to yours, my mind blew. So it is very fun to hear how important it is to your business and where you see the asset class growing. Before we wrap it up, I have basically more of a curious question around sort of this vision of a new funding asset class. Do you think it's like many orders of magnitude better than the existing sort of real estate asset class? Do you think its size is smaller but just higher yield? Like how different is it going to be? And if 5 years is probably not enough. Let's fast forward 20 years, where you've created this whole asset class, and there are public vehicles that I can invest in as a consumer that gets a value from it. What are the dynamics, I guess? Like how do you see it playing out? Do you already have models and examples in your internally where okay, it's just going to be X percentage better or X times better? What are we talking about here?
It depends on the market, so it's all localized. But I can give you an example of actually we own a couple of properties in Nashville, right? And we are doing 3.5x better than the building as it was before we took over, right? In terms of like on a per unit basis, right? We're doing 3.5 better on the units that we've converted over, right, to our use and to our flexible model. And so that gives you a little bit of a feel, right? And if you were to then take that 3.5x on income, right, and multiply that times, because when a building sells, it sells on on the basis of its income, anywhere from, in an apartment world, 20 to 25 times. You think about the
bottom line.
A bottom line. So you think about the absolute value of wealth that creates and how much money we're talking about. This is a game changer in real estate. And because of that, we actually think that all buildings, right, that are multifamily or hotel in nature, and to some extent office, will be built in this flexible way in the future. And I talked about a little bit earlier about it being a self-fulfilling prophecy, in the sense that those who believe in our model will be able, because of the higher income on a risk-adjusted basis that we can create, will pay more for either the building or the land itself to execute this model, right? And so as people lose to the model, right, because they're single-use focused, right, and they lose to people who believe in the flexible model, for them to be competitive in the buy, they actually have to adopt the model and start underwriting. And once they underwrite it, you have to actually execute on it. You have to use it in the building in that way to generate the income to make the returns worthwhile. And so we believe that, the real estate should be built this way day one. Why wouldn't you want flexibility? Why wouldn't you want diversification of income streams when at the end of the day, your downside risk, your downside scenario, right, to the building is just multifamily, which is most people's upside scenario, right? The best a multifamily provider can do, where a building owner can do, is multifamily. Where at the end of the day, what we can do is empty the building of furniture and turn it back into a multifamily building. That's the downside. That's the worst we'll do, is just a straight multifamily building.
Yeah, I can see the investment pitch is very clear to me, right? So there is like more money more money out. What is and you're in a WeWork right now, as you said, at being like sort of like, I'm quite into like aesthetics and design as a person. And maybe because you have different like operators and management companies and in this future that you have, there will be many variations of what you're talking about. The part of my brain that like has some like, I don't like this version of the future that you just explained, is like mostly around vibe, right? I walk into one of these buildings and I think quite a few, even like Airbnbs now, because there is like an interface where I have to choose and pick and sort of book, inherently means that as someone that is providing the Airbnb as the host, I'm going to create a certain aesthetic because that converts better, right? So you're kind of like creating a taste in the economy, or like, this taste that sells better and that it makes more money, but it maybe is like much more manufactured and less sort of organic. I know the forces of the capital are going to push it and create it regardless. The part that is kind of giving me pause is feeling when I go into a building and create my own sort of space, and I know this house has been owned by this grandfather who's been here for so long, and now they're like moving to the suburbs or whatever, and I'm taking over the space. There is sort of like inherent value that I put in a place because it's not as cookie cutter, because it's kind of unique in its own way, because someone's kind of like shaped it to their liking. Obviously, that property type will still be available. It's a massive market. But so much of these newer buildings that are built with this assumption of like, I'm going to fit 2 or 3 people into this place because that's the best way to make the most money out of it, feels like somewhat, and for the lack of a better word, soulless to me. And so how do you think about this? And they have like opinions on this, and how do you mitigate against it?
Yeah. And so I would say first, when I talk about, hey, most urban buildings should be built this way, I'm talking about high density urban construction. I'm not talking about, a row home here or a 5-unit building there or a 6-unit building there, right? Or single family homes or condos, quite frankly, right? That's very for specific use. I think those will continue to be built. But if you're thinking about building a commercial residential property, a multifamily property, or a hotel, right? I think that this is the way you'll do it. And you can still, just like hotel owners and apartment owners today, customize the experience. But I would actually turn that thought process around a little bit on you, right? To say, what happens today when you walk into an apartment building? How long of a lease can you get? 12 months, right? And that is nothing important, like has no importance in your life other than it's a year, and everybody measures everything in a year. And you get a 12-month lease today because the apartment building owner wants you to have a 12-month lease, because what they're trying to do is time your lease expiration along with every other unit's lease expiration. And because they don't have any flexibility, they have to sign a 1-year lease. And so they only want that so many leases coming out in every given month. once you have flexibility of uses, we can customize, and back to like, the customization and really staying the way you want to stay, right? Is we can do a 6-month lease, a 7-month lease, an 8-month lease, a 9-month, because we've got other options. We don't have to try to sign another year lease in December, which is what they don't want because that's low leasing season, right? We have all these flexible options and we can provide that flexibility to you as the consumer. Same thing when you go into an apartment building today. Most apartment buildings, it's similar, is that you can't, if you want a cleaning service or a dog walking service or linen service or clothes washing service, none of that's provided by the building because the cost structure of an apartment building doesn't allow that. But if we run hotel use in the building, we already have housekeepers in the building. All of a sudden, we can provide a la carte luxury to every single resident in that building. Oh, you want your refrigerator stocked? Well, we've already got people in the building. We can do that for you. You want linen service? You want housekeeping service? We've got people already in the building. We can provide that to you, right? If you think about and especially in today's nomadic environment where you may have somebody spending 50% of their time in New York and 50% of their time in LA, you're the case.
I'm doing that right now for context.
Right.
Yeah.
You're probably still paying your New York lease right now, right? You probably still have a home that you're paying for on a monthly basis where you're at. Where in a more flexible environment under our brand and flag is that we can say, hey, you know what? Instead of you having 2 leases, sign 1 lease, right? And then we can fill in the vacancies with different types of stays. Cheaper for you, more value for us, flexibility for everybody, right? And that goes back to like, hey, how do we create ultimately value for the consumers and the residents and those that are staying with us? It's a unique value proposition that you cannot get today. And so I'd argue that it's actually a lot less soulless because we can be flexible in a lot of ways that just does not exist today.
Yeah, and it's funny. So all the things you just mentioned there was a version of me that would have loved hearing that, right? That, I want to sign a lease. I'm willing to pay every month, but I just don't want to be tied to one location because I'm flying a lot. And that my personality's changed. I deeply love spending hours and hours thinking about furniture design and interior design and like going into my own space and experimenting and things like that now. And it's like a very different part of me. But there was like a 10-year period where I would have been a customer of yours very clearly, right? So I think that part definitely fits in. Bao, I appreciate the time. Thank you for coming. I'm super grateful for you to be so detail-oriented, which is exactly what I would have wanted. I'll just get a sense of how you think about growth and building Placemakr. Thank you for showing up. And maybe in a few years, when the new asset class is available, I'll invest in it as well and think of this conversation.
I love it. I appreciate the time. Really enjoyed the conversation.
All right, and that's a wrap. I'm so grateful for this conversation with Bao. It was quite insightful and inspirational to see a founder go through the process of taking an original vision and bringing it through, first making the first version of it happen and then pivoting to this new version and having sort of even the insight of what's going to happen over the long term to take this sort of like consolidated version of their business and decouple it more and more and have different variations of their business as they grow and become sort of a leader in the industry. We've started at Paramount to create a lot more content and host events. So if you're curious about growth and want to learn from us or learn with us, you can go to paramount.com to learn about growth at creative production, landing page optimization, or attribution modeling. We've created pieces of content for all of these things the last couple of weeks alone. And the next episode is going to be my co-founder Kareem coming on to talk about one of our clients and how we've done some work there to grow them across the US. So hopefully that's going to be an interesting one for you as well. And as always, if you are finding value out of this show, please subscribe and follow on whatever platform you're watching. Thank you very much. Have a good one.